You can control 100 shares of stock for 25% of the cost, but if you ignore the width rule, this strategy guarantees a loss even if the stock price doubles. We call it the poor man's covered call, or PMCC. Instead of tying up $15,000 for 100 shares, we buy one deep in-the-money LEAPS call for roughly $3,500. This LEAPS option acts as our synthetic collateral, allowing us to sell near-term calls against it for monthly income. But here is the trap that bankrupts beginners. Since you don't own the shares, you have created a diagonal debit spread. If the stock skyrockets past your short strike, and the width between your strikes is less than what you paid, you lock in a guaranteed loss. To prevent this, we must select our LEAPS with surgical precision. Referencing our Phase 3 Greeks module, we require a long delta of at least 0.80. This ensures our option gains value almost as fast as the stock itself, minimizing the extrinsic value that works against us. Against that deep LEAPS, we sell a short call at the 0.30 delta or lower. This specific ratio, long 80, short 30, creates a net positive position that benefits from theta decay. We need the stock to rise, but slowly, staying below our short strike. If the stock challenges your short strike, do not panic. Simply roll the short call up and out for a net credit. Every credit you collect reduces the cost basis of your LEAPS, effectively using the market's money to pay off your rental of the stock. Master the leverage, but always respect the debit spread math.